everyone. It is a Thursday and it is already August 12, 2021, and we're going to report the Awesome 10X global market updates and news. So let's go for the news first. All right. So you've got some good news from Innoviz Technologies. Let's read that. Reporting their second quarter results. Let's read that for you. Innoviz solid state LiDAR sensors reporting financial results and guidance. Commercial traction, significant progress, and high performance in the global business generation strategy with prospects and potential customers facilitated by their research and development teams. Realized continued momentum from their shuttle program designed with continuous aim to increase volume through additional orders in the near future. They've won advanced development projects with a European autonomous truck company, providing Innoviz to equip the customer's 2021 fleet with Innoviz technology. Innoviz believes they're well positioned for pursuing multi-year contracts after the testing phase is complete. For this quarter, they secured 4 new technical partnerships, expanding the company's presence in Asia. Number 1, EDOM, one of Asia's largest electronics and semiconductor distributors, are seeking to drive sales, enhancing support initiatives for Innoviz LiDAR solutions in the Greater China's region. Whale Dynamic, China-based full-stack Level 4 autonomous driving company, will utilize Innoviz LiDARs, replacing their previous generation Innoviz LiDAR as their primary sensor with the goal of creating the world's best sensor fusion design. Number 3, Spring Cloud, Korea-based business-to-business autonomous mobility as a service provider, is going to conduct autonomous driving data analysis and validation to distribute Innoviz products in Korea across multiple sectors. Curium is a Singapore-based autonomous driving platform provider focused on calibration, integration of LiDARs, and other sensors for autonomous driving that is promoting Innoviz LiDAR in the region. Leadership, they've completed several design cycles and are on the verge of freezing the hardware design for Innoviz One. They believe they're the first in the industry to reach this milestone and seeing a strong traction for their product. They also developed early samples of Innoviz One Plus. This is an enhanced version featuring components developed for Innoviz 2, extending the range and resolution. They're also completing optical design of Innoviz 2. This is a company's top-of-the-line LiDAR using a single laser and detector, advanced packaging electronic design at 70% material cost reduction compared to Innoviz 1. They also surpassed 1 million object annotations with Innoviz automotive pre-perception platform Innoviz app. Corporate development, so far they have 337 headcount. Approximately 70% of those are R&D team. We are making remarkable progress in our global business development in advancing our technical standards. We are humbled to receive so much positive feedback. Revenues for second quarter is just $1 million, an increase of 38%. And then, of course, most of these revenues are actually because they're still in the R&D. So they are seeing strong demand for their products and expecting a positive momentum to continue. OPEX is $70 million. This is an increase on OPEX. The increase in OPEX is primarily due to stock-based compensation. Additionally, they're still heavily investing in R&D. Expenses are now totaling $32 million, of which 17 million was attributable to stock-based compensation. So far, the company has $156 million in cash, $195 million in short-term deposits. Okay, so Innoviz right now, the chart here is actually trading from as low as $8, now trading at $9.55. Do note that there could be resistances here at about $11. We like the results, but we are also aware that there will be resistances on the way. Those people who don't have it might actually want to buy below 9 if they can. So you can wait, because sometimes after an earnings result of a good move, people will actually sell it the next few hours or the next few days. So you can still try to buy below 9 for those who don't have Innoviz. Okay, let's take a look at on a result. Ouster, of course, reported results as well. So if Innoviz had $1 million, Ouster had $7 million in revenue, up 72% year over year, 26% gross margins, record shipments of over 1,460 sensors. This was on August 9. Ouster, a LiDAR company, reported growth, shipped over 1,460 sensors, an increase of 342% year over year. They've increased their total number of strategic customer agreements to 53, collectively representing over $422 million in contracted revenue opportunity. Their net losses also increased to $32 million, adjusted EBITDA loss of $14 million, up from $9 million. So both entities are actually loss-making, both Ouster and Innoviz. Business outlook, let's take a look. Ouster expects to receive $33 to $35 million of revenue. And for the full year 2021, we expect that our path of becoming the leading Lidar company across each of our 4 verticals is demonstrated through our results, differentiated technology, most diversified customer base among Lidar companies, and a proven ability to execute. Actually, the market is happy with Ouster's results. Let's show to you the numbers here. Even if it's just a $7 million sales, people are actually willing to buy the dips on Ouster. You could see that here about 8.7 and here at $10, it has been bought out by the market. And we will still continue to see that any dips below $9 for Ouster, both for Ouster and Innoviz, has a lot of buyers. Okay, so both Lidar companies are doing well after earnings results. Tonight, Laser is going to report numbers here at about 17-18. We're also expecting a good jump. So let's see whether earnings tonight of Laser will not disappoint. Laser, of course, already has incumbent Volvo as their primary tier 1 automaker, auto client. So we'll see what else they have in store for us. This, of course, perhaps another SPAC that reported numbers that is actually generating some upside surprises. Clover Health reports their second quarter results. Let's just read this. Total revenue is actually up 140% for Clover Health, $412 million. Their lives under Clover management nearly doubled to approximately 129,000, and they're on track to manage over $1 billion of annualized revenue. Clover Health is a next-gen healthcare company improving healthcare outcomes for America's seniors. Okay, let's take a look. Clover took another step in the journey to improve every life with the launch of direct contracting this past quarter. This milestone more than doubled our revenue, nearly doubling the lives under Clover Assistant management. We've got ambitious goals, improving every life, making great healthcare affordable and available to all American seniors regardless of health and wealth. Andrew Toy, president of and CTO of Clover Health, said, Clover Assistant continues to be a key differentiator underpinning our unique model. It has approximately 95,000 lives under management and is on pace to manage over $1 billion of annualized revenue. Let's see further from their financial highlights. So we believe our normalized MA GAAP, which adjusts for COVID-related impacts, is seeing positive results for members and Clover Assistant providers. Let's take a look, dollars and millions. So from 172 million, it's 412 million. GAAP, Medicare Advantage, medical care ratio, it's 111%. Salaries and benefits is $107. I don't understand what these mean. But this is what alarms me. Despite that $400 million revenue, there's also net loss of $300 million. So I'm quite skeptical of the movement on Clover Health. Nonetheless, this is an actual surprise, I believe, that the market didn't foresee for Clover Health to register a 140% increase in their revenue coverage for this quarter. So we'll see later on. Another result, we've got so many results. Let's take a look on the earnings and acquisition of Desktop Metal. So Desktop Metal, after reporting good results are actually good, has also discussed acquiring X1. That's why X1 is actually trading after hours about 30-40% higher. So at the part of its earnings call this week, Desktop Metal announced their plans to acquire X1. The Pennsylvania-based firm is creating a variety of different industrial 3D printers for industries like aerospace, automotive, medical, and defense. We recently wrote about the company's portable 3D printing factories, which effectively mobile additive manufacturing stations built inside shipping containers. So X1 is a company granted $1.6 million from DoD in hopes of taking the systems out into the field. Each unit contains a 3D scanning station with a computer and a variety of different ruggedized industrial machines, including a metal and ceramic printer, curing oven, fiber reinforced plastic printer, and a compressing modeling station. It's going to be bought out for $575 million. We are thrilled to bring X1 into the Desktop Metal family to create the leading additive manufacturing portfolio for mass production. It's gonna be done for $25.50 per share. So I think the shareholders will receive, some X1 shareholders will receive cash and stock. You'll receive a portion of Desktop Metal and also $8.50 in cash, $17 worth of Desktop Metal shares. Okay, so we'll see whether so far this is how Desktop Metal is doing. It is $9 here, although after hours could be higher at about $9.50 or $9.60. I'm not yet sure what happens to Desktop Metal after hours, but I surmise that the company is getting a positive review after the earnings results. The earnings results, let's just read to you Desktop Metal's earnings results. Desktop Metal's revenue is $19 million, up 68% from the first quarter of 2020, and up 767% from the second quarter. Up 68% from first quarter of 2020, up 770% from 2Q 2020. Net loss is still huge at $43 million. These are companies that are still including R&D in their assets, and they're acquiring a lot of companies. Strong liquidity position with about $514 million as of June 30, 2021. Let's take a look at their business highlights. Desktop Metal had a momentum with customer adoption growing 44% sequentially, accelerating metal system shipments, including strong growth across production systems P1, shop system, and studio system 2. Production system P50 is on track to begin shipments in fourth quarter of 2021. Continued material portfolio expansion, including cobalt, titanium, and low alloy steel, stainless steel on their Envision Tech platforms. Forus product launch exceeding all expectation with overwhelming demand. Acquired Aerosynth. This is an acquisition, multi-material capabilities to their AM 2.0 portfolio. Acquired Beacon Bio, adding phonograph biofabrication platform to the Desktop Health portfolio. They closed Additive 3D acquisition, bringing best-in-class customers to market alongside the Envision Tech like the Extreme 8K. They also grew Desktop Metal team to over 500 employees, up from 171 employees in August 2020. So far, Desktop Metal is showing us that they are actually capable of being some of the leaders in the additive manufacturing. We saw great numbers on Desktop Metal, great numbers from Materialize Proto Labs. We also saw good numbers on 3D systems. And so we are actually thinking that there will be good numbers coming out next week on Nano Dimension, either from their acquisitions or another just really acquiring customers. So in general, additive manufacturing as a group is a good move. Okay, so another last but not the least, Hims & Hers. This SPAC reports second quarter results exceeding upside. Revenue is growing 69% year over year to $60.7 million. Hims & Hers online revenue, their e-commerce is growing 75% year over year to $58 million. They are exceeding their 2021 full year guidance and they're raising expectations. So Hims & Hers is actually up, I think 9 or 10% after hours, and yet we are still bullish that it can continue going higher. Dips would be bought. There's a multi-specialty telehealth platform connecting consumers to licensed healthcare professionals. This is a quarter of very strong execution as we continue to drive consistent organic revenue growth across businesses from core categories to newer mental health services. We are heavily invested in key infrastructure and differentiated technologies. These are long-term plays driving financial improvement and creating a durable advantage. Our vision for the future is simple: building Hims & Hers to a new front door to healthcare. For dozens of medical specialties, welcome customers of all demographics for a unified consumer platform that looks and feels and talks to them in a way that gives them confidence and they're in the right hands. Hims & Hers also completed the acquisition of Apostrophe. This is a teledermatology specialist and compounding pharmacy, as well as Honest Health, a London-based vertical health platform. They believe these acquisitions will accelerate their growth in new verticals and specialty verticals, so dermatology and whatever Honest Health does. Let's see. So strong growth in their revenues for the quarter. We can see an acceleration quarter on quarter as well as year on year. So they also are growing their guidance for the next year or full year 2021. Revenue is going to be $251 million to $255 million. And EBITDA is gonna be from loss of 35 to loss of $40 million. So most SPACs are still losing money, but we are seeing that what's important for them is they're growing their revenues. So we are seeing some charts. Let's take a look. Desktop Metal, Hims and Hers. Oh, last but not the least, let's talk about the disappointing large loser last night, which is AppHarvest. AppHarvest closes down 30% last night and gets a sell for all of us. Even if you have to take a loss, you have to take it as they lower their forecast from $25 million revenue to $8 million for the year. Let's take a look at AppHarvest disappointing numbers. Okay, let's just read through it. Company reports their quarterly revenues of $3.1 million below the estimate of $5.67 million. AppHarvest also lowers their target revenue range from 20 to 25 million to just $7 to $9 million. So a big portion of that revenue cut is because, as they said, tomato sales are lower for this year. We believe, however, that let's just read through it. Jonathan Webb, the founder and CEO of AppHarvest, said, "We believe, however, that our world-class technology is still positioned to become a global leader in the industry." They're actually at new lows after the results, and they're actually sharing that they're going to grow their SaaS-based business to be more of selling their technology to other farms for growth. Let me just read to you all the numbers. Our AppHarvest 2Q 21. Investors relations forecast goes flat. All right. So it is the largest loser last night. Their 2022 to 2025 results, however, are still maintained, but the market has lost confidence in their results. So let's just read through their results. 2Q 2021 results. I'm not that bearish in the company, but I would understand that for the next few months, because it's going to take them a year, end of 2022, for their next facility to come online, their revenues will not improve for this year, and therefore everyone who has AppHarvest might actually get an opportunity to get a better entry next year at a perhaps lower level. So that's the reason why there's a ton of selling pressure on AppHarvest. It's a matter of execution. Wait, why can't I see the AppHarvest results? Press release. Earnings 2Q, 12 hours ago. All right. So here, let's read this, okay? So their plan for new holding company structure will capitalize on selling their technology, essentially, announcing a non-binding LOI for JV with Mastro Nardi Produce to expand their farm network, but they are reaffirming their long-term outlook. So far, it seems as if constructing their own farms and selling tomatoes is not going to deliver a lot of revenues. And so what happened here is they secured a lot of financing from other companies to construct more farms and to actually sell and not necessarily sell, but basically franchise out their technology. Let's read it together. AppHarvest is focused on farming more sustainably, got it. And the results are very low. You could see that net sales is 3 million, an increase of just 0.8 million from the first quarter of 2021. And so far, they are reporting net loss of $32 million. They're also expecting a huge loss of $70 million for the year. So the market is actually not happy with that losses. Therefore, it got sold down. So while we are more than doubling our production, we have a moment in time opportunity to create more long-term shareholder value by doubling down on investments, developing and deploying our leading technology and operational best practices, and launching value-added products next year. So they're actually, I think not everyone likes the fact that if you're losing, that you're doubling down. That's why it got sold down. What are their actions to capture long-term value? Let's read through this. Company is saying that they will actually, what's this? Their decision is to shift to transform their assets and teams into global authorities in the CA sector. The dedicated space at Moorhead Farms will be allocated to non-production skunk work strategic investment to better facilitate the development for viable commercial technology, which the company anticipates will be integrated to best practices in future farms licensed to other CEA operators or controlled environmental agriculture operators, expecting the long-term benefits with evolving business model to significantly outweigh the near-term investment cost. Company has made progress building their brand as a competitive advantage, important driver of their long-term shareholder value. They are planning to release 3 products. These are their products. Appalachia Co. is going to be planned network of high-tech indoor farms in Central Appalachia and proposed value-added products business. Then they're going to sell their technology, which is their proprietary farm ops robotic harvesting capability and an AI machine learning for growing, as well as the potential to develop new revenue streams through licensing their CA technology to global operators. That's their tech company, so they want to be a SaaS firm there. And then Grow Company, which will pursue CA opportunities, including those outside of Central Appalachia into the US and globally. So in my view, they're trying to do something like a franchise system wherein they're going to sell their technology and help other farms actually incorporate indoor farming and robotic harvesting capability. I don't think it's a bad thing what they're doing, but the market is actually generally negative with their business model. That's why they think that this pivot is actually because their current business model doesn't work. So, so far, their Moorhead facility has been harvesting and they're operating up to 12 high-tech indoor farms. They plan to operate 12 high-tech indoor farms. 2 of the facilities are under construction in Berea, Kentucky and Richmond, Kentucky. These are 37% complete. Richmond tomato facility is 31% complete. It's going to be fully operational by mid-2022. Groundbreaking for 2 more facilities occurred in June 2021. And they're expected to grow berries and more leafy greens. These facilities will be very much end operational by end of 2022. Another operational performance is assuming responsibility with the AppHarvest President David Lee. As part of their reorganization, they're focused on improving accountability and cost containment to drive better profitability and quality. So he is, of course, the CFO before of Impossible Foods, and he's going to be the president of AppHarvest to make sure that cost and profitability are done well. So CFO, he's done finance, so he's going to be bringing significant experience from his financial background to make the operational efficiency for AppHarvest. Okay, so we'll see how they will also build through the technology company. Let's read through this. For their technology, they hired Josh Singh to build the tech company business to develop leading CA solutions to optimize AppHarvest farms to sell these turnkey solutions to the global market. So existing solutions will require experienced master growers and farm operators who are in limited numbers. So their solution is to de-risk the farm management process through automation, and they're going to allow target customers in countries that lack the geography, labor needed to deliver this industry-leading operational result as they work to ensure climate-resilient food security. TechCo so far has secured their first customer, being a pilot of farm ops technology developing for Red Sea farms. This is a controlled environmental agricultural company based in the Middle East to build 500 acres of indoor farms in the region by 2025. Piloting farm ops within Red Sea farms will give us the unique opportunity to demonstrate the efficacy of our system in one of the world's most challenging environments, the Arabian Peninsula. So we'll see whether AppHarvest is going to build their tech company business with this Red Sea farms and whether it will do well. It's really a tough thing, Middle East, but if they do well, that's going to be good. Let's read further about their diversification. So far, they are potentially having a joint venture with Mastrodarni Produce. Mastrodarni is a partnership that is going to be a JV. It is an executing non-binding letter of intent to form a JV, pursuing opportunities to build and operate high-tech CA facilities, acquiring existing CA operations, and expanding the production through the U.S. AppHarvest and Mastrodarni. They worked together since 2017, and they would exclusively distribute AppHarvest produce. The plan is for each partner to contribute the farm and for AppH to contribute $10 million in cash. Farmco would use the contributed assets to raise additional capital to finance their growth, targeting to build a network of CA facilities in US to grow fresh fruits and vegetables, including leafy greens. So with this secured financing, they're targeting for the first quarter of 2022 to launch. We believe Farmco is one of the most promising opportunities with our grow company business because we believe it has the potential to become a large financial opportunity just like Appalachia Co. The proposed JV would have the ability to obtain separate sources of fundraising and is designed so that the financials can be consolidated by AppHarvest. So I think most of the good numbers in AppHarvest is coming 2022. So if you can actually wait for the next year, some people are willing to actually sell first, and then when they're in doubt of the business model, usually traders will sell first. However, I'd say that with balance sheet still $270 million, and with a plan, you might have to wait 6 months to buy back into your AppHarvest. So in the short term, I do think AppHarvest goes from about $9 all the way to about $6 or even $4. There will be some resistances if it manages to go up 11. So the new range for the next 6 months to 12 months for AppHarvest is somewhere in the line of 6 to 11. That's why you have a lot of selling pressure last night. And I'd say any rallies from about 9 all the way to 11 will remain some selling pressure. Last but not the least, let's take a look at another loser, Space. Space, Virgin Galactic is falling from 34 down to 27. Can it go down, and where will it fall? If it falls, it can go to as low as $23 to $25. And I think the first support, if you have to assume the worst, is about $23 to $23 at the very least. So that would be about 20% further losses. Why is it further losing money? Virgin Galactic announced selling $450,000 seats sale, but they actually still have to produce a lot of losses for each flight. So far, people are actually skeptical on whether their existing $250,000 price tickets, which had $600 pre-ticket booking, is gone profitable. So with losses to boot on Virgin Galactic, some people are expecting more losses, and that's why there are selling pressure happening. So we are seeing actually Virgin Galactic fall further. Any dips right now is going to be, I'm not sure if it will contain in 23, but so far 23 level has been a bullish part for Virgin Galactic. So assume a huge range, 23 to 33, lower ranges for Virgin Galactic for the next 3 to 6 months. Okay, so let's take a look at your questions, if any comments. NanoX, I didn't read, but I think it had bad numbers. So I think like no reason to get. AppHarvest, so expect a loss of movement here. You'll see a lot of people continually selling their AppHarvest. We would suggest actually shift from your AppHarvest $9, exit, and then go for other companies like Hims & Hers, because Hims & Hers is doing well. And actually shift the Desktop Metal, which is also trading at 9. So you can actually shift to other winners. Last but not the least, for Virgin Galactic, another thing to actually shift upon is go to GSAT. So we are seeing that within the space industry tourism, Global Star Satellite is actually doing better for providing internet. So in case you want to have actually better broadband connectivity, space issues right now are more in the traditional format and not in the space tourism kind. So this might be an actually cheaper way and better way to actually shift your Virgin Galactic. We would recommend to sell and shift some of your losers to these potential winners. Global Star, shift your space to shift Virgin Galactic to Global Star. That seems to be an okay move. And then shift your AppHarvest towards either Desktop Metal, Hims & Hers. So far, I think those are good opportunities. Or if Ouster and Innoviz falls below 9, that could be another opportunity. Okay, so or you can even take a look later on when Origin reports their numbers. If it's very good, here at about $6, it can potentially go back to $7 or $8 or even 10. So you might as well actually shift to other SPACs that are also misunderstood. From a misunderstood SPAC to another misunderstood SPAC, since you already know that the earnings of AppHarvest is quite murky and they're actually pivoting to new business model, pivoting to a new structure in their business model, it is still a question mark on whether they can actually franchise and license their technology to other businesses. Okay, so I think that's the safer way and safer route for the SPACs. That's it. See you later. There will be earnings announcement tonight. A lot of earnings this for this Thursday. You've got Disney, Palantir, you've got Airbnb, you've got Wish, Origin, Laser, and that's just a few. There's a lot more that will report earnings updates. See you again tomorrow, and then have a good day. Thank you very much. Refocus your portfolio towards the winners, exit your losers. That's it. Bye-bye.